Hello, today we'll be talking about the secondary mortgage market. We will go over a basic definition of what it is and how it works. We will also look at the government-sponsored enterprises like Fannie Mae and Freddie Mac. First, how does it start? Suppose that there is a family that wants to buy a house. They go to the bank and ask for a mortgage loan. Then, if the person requiring the loan covers the requirements, the bank approves the loan. The bank takes the money out of the reserves and gives it to the customer to buy the house. Suppose the bank has enough money just for one mortgage. When it lends it out, the bank is left out without money, except for what it collects from the borrower every month. But then you have just graduated from college and found an awesome job that pays you 90 grand a year, and you decide that you want to buy a house too. Suppose you go to the same bank that the previous family did. You wouldn't be able to get the loan because the bank has no money. It had already lent it out to the first family. Now you have to wait 15 to 30 years for the bank to have the money to lend it out to you, or even worse. If the first borrower died and never finished paying the loan, the bank would never be able to recover the money and it will run out of business. Yes, that would be bad. Second, the government came out with a solution to this problem in 1968 by sponsoring Fannie Mae and Freddie Mac as the institutions in charge of the secondary mortgage market. These are the first two government-sponsored institutions to cover the banks from losing money through the mortgage market. Let's go back to our example. In the secondary mortgage market, we have Fannie Mae and Freddie Mac. These institutions provide insurance to the bank in case the borrower doesn't pay. So if the first family that obtained a loan decides not to pay for whatever reason, Fannie Mae comes in and pays the bank for the remaining balance of the loan, so the bank will recover the money and will be able to lend it to you. Now, to allow the bank to lend to a third borrower, Fannie Mae will buy your loan and pay the bank, so it will be able to have money to lend it to a third borrower. We are in this part. Then, in the secondary mortgage market, these institutions compile mortgage loans and they sell them to the investors. We call the bank the originator of the market, and these institutions the aggregators, because they compile the loans and sell them as a big package in the stock market. The institutions in charge of compiling loans in packages sold in the stock market are government-sponsored. They have a non-government owner, but are subject to strict legislation and regulation. The most important secondary mortgage market institutions are Fannie Mae or Federal National Mortgage Association, Freddie Mac or the Federal Home Loan Mortgage Corporation, and the Federal Home Loan Banks. Ginnie Mae is a government-owned institution, and it doesn't play a big role in the market right now. The advantages of this market are reflected in high liquidity for banks and low interest rates for mortgages, which increase the demand for loans and make them more accessible to the borrowers. The government is interested in making mortgage loans accessible to low-income population in different areas, and has set restrictions and regulations to increase the controls of the institutions to avoid fraud. In the current situation, according to the report for the third quarter in 2017, Freddie Mac multifamily funded 190,000 apartments. It also funded $43 billion in mortgages. Fannie Mae funded a record of $55.3 billion in mortgages and 724,000 family houses. The performance of Fannie Mae in the stock market does not look promissory since the price has been volatile and Freddie Mac has reported not very attractive profits. As an interesting note, today the stock price of Fannie Mae opened at $1.42 and closed at $1.43. The maximum was $1.45. This is my presentation and thank you for watching.